Most people believe wealth grows like a staircase, one step, then another. Hard work today, a little progress tomorrow. Slow, steady, predictable. That belief ruins more financial lives than bad markets ever could. Because the truth is uncomfortable, and almost nobody is warned about it in time. There is a stretch of the journey where effort feels pointless, where years of discipline barely seem to move the needle, where saving feels like shoveling sand into the wind. And this is exactly where people give up. They don't quit because they're lazy. They don't quit because they're foolish. They quit because the feedback is misleading. For a long time, money doesn't feel like it's working. It feels heavy, resistant, silent, like pushing a stalled car uphill with no idea whether the engine will ever turn on. So people draw the wrong conclusion. They assume this is as good as it gets. They assume the grind never ends. They assume wealth is reserved for people who got lucky, inherited something, or took wild risks. And right at the moment when quitting is most tempting, right when discipline feels most unfair, the math is quietly preparing to change. Not gradually, not politely, but decisively. There is a point, most people never reach it, where effort and outcome stop moving together, where progress stops matching labor, where money begins behaving differently than it did before. Before that point, everything feels earned the hard way. After that point, things feel lighter. The problem is that this shift doesn't announce itself. There's no headline, no notification, no applause. And if you turn back too early, you'll never even know how close you were. That's why so many intelligent, disciplined, hard-working people spend decades doing the right things and still end up disappointed. They weren't wrong. They were just early and impatient at the worst possible moment. Charlie Munger once warned that the most dangerous mistakes aren't dramatic. They're quiet. They happen when nothing seems to be happening. Today, we're going to talk about that invisible turning point, why it exists, why most people never reach it, and why crossing it quietly reshapes everything that comes after. But first, you need to understand why the middle of the journey lies to you. For Americans in midlife, money anxiety doesn't arrive all at once. It creeps in quietly. It shows up when retirement stops feeling distant and starts feeling measured. When the calendar suddenly matters more than the paycheck. When you realize time, not income, is now the most limited resource you have. By your late 30s, 40s, and 50s, most people have done many things right. They've worked consistently. They've avoided obvious disasters. They've built careers, families, obligations. And yet, there's an unsettling question that keeps resurfacing. Why doesn't this feel more secure than it does? That question isn't about greed. It's about control. At this stage of life, people aren't chasing yachts or headlines. They're chasing something quieter: predictability, dignity, and the ability to say no. The fear isn't poverty in the abstract. The fear is running out of options. That's why the middle years are dangerous. Not because people stop caring, but because they start doubting the system. They look at years of effort and feel underwhelmed by the results. They hear conflicting advice. They watch markets swing. They see others seemingly leap ahead overnight. And slowly, confidence erodes. This is where impulsive decisions are born, not from recklessness, but from frustration. Charlie Munger spent a lifetime studying exactly this moment. Not the flashy wins, not the lucky breaks, but the long stretches where nothing appears to be happening. He understood something most financial conversations miss. Human behavior matters more than intelligence. Most people don't fail because they lack knowledge. They fail because the timeline doesn't match their expectations. They expect progress to feel proportional to effort. When it doesn't, they assume something is wrong with them, with the market, or with the strategy itself. That assumption is costly because the financial system rewards endurance, not enthusiasm, and endurance is hardest when results lag behind discipline. This is especially relevant now. Americans today are navigating longer lifespans, uncertain pensions, volatile markets, and rising costs. The margin for error feels thinner than it used to. Mistakes feel more permanent. Second chances feel fewer. So people look for certainty, shortcuts, signals that they're on track. But wealth doesn't provide reassurance early. It withholds it. It tests patience first, conviction second, and only later does it offer momentum. The core problem most people face isn't low income or bad luck. It's misreading where they are in the process. They confuse the hardest phase with a failed phase. They interpret silence as stagnation. They underestimate how close inflection points often are. And by doing so, they abandon the very position that would have changed everything. Before we talk about what to do, we need to correct how this journey is understood. Because without that correction, even good advice becomes dangerous. The foundation of long-term wealth isn't brilliance. It isn't hustle. It isn't finding the right stock. It's understanding how progress actually behaves in the early years and refusing to misinterpret what you see. Most people assume growth should feel proportional. Put in 10% more effort. Expect 10% more results. Save twice as much. Feel twice as secure. That mental model works for salaries. It fails completely for capital because capital does not grow in a straight line. Early on, it grows so slowly that it looks broken. The math is working, but the feedback is delayed. This is where the first and most dangerous misconception takes hold. If it's this hard now, it will always be this hard. That belief causes people to sabotage themselves right before the mechanics change. The core principle here is simple, but emotionally brutal. Compounding rewards size and time, not effort. Effort builds the base. Time and size create momentum. Before the base is large enough, compounding feels invisible. After it crosses a certain threshold, it becomes undeniable. Let's dismantle the misconception. People talk about saving as if each dollar behaves the same, but it doesn't. The first dollars you save work the hardest and show the least. They carry the burden of building the machine before the machine can do any work. Imagine two savers. One reaches 100,000 and feels proud, but frustrated. The number looks large, yet life feels unchanged. No freedom, no margin, no sense of leverage. That frustration is logical, but misleading. At that stage, money isn't meant to feel powerful. It's meant to be positioned. Now consider a numerical example, kept deliberately simple. Assume someone builds their net worth to 100 and earns a long-term average return in the high single digits. The growth exists, but it doesn't change behavior or lifestyle. It's absorbed quietly by inflation, taxes, and psychology. But as the base grows, something subtle happens. At 200,000, the annual growth still doesn't feel life-altering. It's noticeable, but not decisive. The saver still feels like the primary engine. Then the base increases again. At 300,000, capital starts to participate meaningfully, not replace work, but assist it. At 500,000, capital begins to argue back. It contributes enough that decisions feel different. Risk tolerance changes. Time horizons stretch. This isn't about luxury. It's about control. And this is where many people make their mistake. They treat the early grind as proof the strategy is flawed, rather than evidence they're still in the foundation phase. Charlie Munger spent decades emphasizing this idea in plain language. One of his most quoted lines captures it perfectly. The first rule of compounding is never interrupt it unnecessarily. That rule exists because interruption hurts most before compounding becomes visible. Spending too early, switching strategies too often, chasing excitement because boredom feels like failure. These actions feel small in the moment, but mathematically, they're catastrophic. Here's why. When capital is small, every dollar has a future multiple. Remove it early, and you're not just losing the dollar, you're erasing everything it would have become. This is why patience matters more in the beginning than at any other time. The foundation phase is not about optimization. It's about survival and continuity. The job is not to be clever. The job is to stay in the game long enough for size to matter. That's why Munger consistently warned against trying to be smart too early. Complexity before scale is wasted intelligence. The common misconception is that wealth is built by doing more things. In reality, it's built by doing fewer things for longer. The early years demand restraint. They demand delayed gratification without applause. They demand faith in arithmetic when emotions see no reward. This is also why comparisons are dangerous at this stage. Someone else's sudden win can distort your timeline, but isolated outcomes don't change the math of accumulation. The foundation phase is intentionally unglamorous. It's meant to filter out impatience, because once capital reaches a certain mass, behavior becomes the dominant factor. Not effort. That's the hidden bargain. Suffer quietly early, and the system works with you later. Demand proof too soon, and you reset the clock indefinitely. So, the foundation principle is not compound interest in theory. It's respecting the phase where compounding hasn't revealed itself yet. People who understand this stop asking, "Why isn't this working?" and start asking, "How do I avoid interrupting it?" That shift alone separates those who eventually feel momentum from those who never do. Understanding the principle is useless unless it survives contact with real life. This is where most people fail. Not because the idea is wrong, but because application exposes impatience. Let's translate the foundation into behavior. The practical application of early-stage compounding is brutally simple. Protect the base at all costs. Not optimize it. Not impress anyone with it. Not accelerate it recklessly. Protect it. That sounds conservative, but it's actually aggressive in the only way that matters. Longevity. Here's a hypothetical case study. Intentionally ordinary. Imagine an American household in their early 40s. 2 incomes, stable careers, no windfalls, no inheritance. Through consistent saving, tax-advantaged accounts, and boring investments, they reach a net worth in the low 6 figures. Progress feels slow. Life feels expensive. Peers appear to be doing better. This is the danger zone. At this stage, temptation arrives wearing different disguises. One voice says, "We should enjoy life more. We've earned it." Another whispers, "We're behind. Maybe we need something with higher returns." A third suggests, "Let's pull back until the world feels safer." Each voice sounds reasonable. Each one attacks compounding differently. Let's run the spoken math. Not to teach, but to expose trade-offs. If that household allows lifestyle expenses to rise meaningfully before the base is stable, progress doesn't just slow. It reverses. Savings rates drop. Time extends. The finish line moves. If they chase speculative returns, hoping to compress the timeline, they introduce the possibility of permanent loss. And permanent loss doesn't delay compounding. It destroys it. If they step aside waiting for clarity, they exchange uncertainty for certainty of opportunity cost. None of these mistakes feel reckless in isolation. They feel justified. That's why they're so common. The application principle is this. In the accumulation phase, your primary enemy is not the market. It's your own behavior. Most Americans make the same set of errors on the way up. First, they increase spending. The moment their account balances look respectable, not extravagantly, just enough to matter. New payments, new commitments, new expectations. Second, they confuse activity with progress. They trade, they tweak, they react, and every reaction interrupts the clock. Third, they abandon consistency for excitement. They mistake boredom for inefficiency. Now contrast that with disciplined application. The household that treats early capital as untouchable behaves differently. They automate contributions and ignore headlines. They resist lifestyle inflation until capital, not income, pays for it. They keep portfolios simple, not because complexity is bad, but because simplicity survives stress. They accept volatility without action. They understand that temporary declines are not instructions. This is where Charlie Munger's thinking becomes practical, not philosophical. Charlie Munger repeatedly emphasized that the real edge isn't intelligence, it's temperament. Smart people fail here because they overestimate their ability to intervene successfully. Average people succeed because they leave well enough alone. Here's what disciplined application looks like in plain terms. Contributions continue, regardless of mood or market. Asset allocation is chosen once and revisited rarely. Cash is held for stability, not prediction. Spending increases only when investment income, not salary, supports it. This approach feels slow. That's intentional. The goal is not to arrive early. The goal is to arrive intact. And when the base grows large enough, behavior naturally becomes easier. Volatility matters less. Noise fades. Choices widen. But none of that happens if the early years are spent fighting the process instead of cooperating with it. The irony is that disciplined application doesn't require heroics. It requires refusal. Refusal to chase. Refusal to compare. Refusal to interrupt. Most people don't lose wealth because of one dramatic mistake. They lose it through a series of reasonable decisions that collectively reset progress. The application phase is where those decisions are prevented. It's where the foundation is allowed to harden long enough to support everything that comes later. And once that happens, the conversation shifts from "how do I get there?" to "how do I avoid getting in my own way?" Once the base is built and protected, the conversation changes, not dramatically, but decisively. This is where most advice becomes dangerous because it assumes people need more action. In reality, what's needed is less interference. The advanced insight is not a trick. It's a reversal. The biggest gains don't come from doing more things right. They come from avoiding a few things wrong consistently for a very long time. That sounds obvious. It isn't practiced. At this stage, capital has enough mass that errors are amplified, not just gains. So the real skill shifts from accumulation to error minimization. This is where Charlie Munger's philosophy separates itself from conventional finance. Charlie Munger often frames success through inversion, by asking not, "How do I succeed?" but "How do I fail?" That lens changes everything. Instead of chasing higher returns, you focus on avoiding permanent loss. Instead of predicting the future, you build resilience against being wrong. Instead of optimizing, you simplify. This is the secret sauce most people miss. As wealth grows, restraint becomes more valuable than intelligence. Here's the contrarian perspective. The financial industry thrives on movement. Products, strategies, narratives, always changing. But wealth thrives on stability. The advanced investor isn't the one with the most opinions. It's the one with the fewest decisions. Munger understood that temperament compounds, just like capital. A calm mind avoids errors. Avoided errors preserve capital. Preserved capital compounds. That loop is powerful and invisible. Consider a real example from Munger's career. Not about brilliance, but patience. For long stretches, he held concentrated positions through periods of discomfort, not because he enjoyed volatility, but because he understood the cost of unnecessary action. He accepted drawdowns without flinching. He tolerated boredom without seeking stimulation. He waited. Not passively, but deliberately. That waiting is what most people underestimate. Because waiting looks like inactivity. But mathematically, it's the most productive state capital can be in. The elevated insight is this. Once compounding is working, the primary risk becomes you. Not inflation, not markets, not news. You. Your urge to improve what isn't broken. Your desire to feel clever. Your intolerance for quiet progress. That's why advanced wealth building often feels anticlimactic. No constant monitoring, no frequent adjustments, no adrenaline, just ownership, time, and discipline. Munger captured this with one of his most instructive lines. It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. That statement is not humility. It's strategy. Avoid leverage that can force selling. Avoid complexity you can't explain. Avoid dependence on forecasts. These aren't conservative rules, they're survival rules. The advanced mistake is thinking you've earned the right to loosen discipline. That's backward. Discipline earns freedom. But freedom doesn't eliminate the need for discipline. The truly wealthy don't feel compelled to prove anything. They don't need constant confirmation. They let the math speak quietly over decades. And this is where the compounding curve becomes asymmetric. At larger bases, the downside of mistakes grows faster than the upside of brilliance. So the optimal strategy becomes boring by design. That boredom is not a flaw. It's the signal that the machine is running correctly. The advanced insight, then, is not about finding a new edge. It's about protecting the edge you already have. Because once capital reaches critical mass, time does the heavy lifting, if you let it. At this point, the question isn't philosophical, it's practical. What do you do tomorrow? Not in theory, not in a perfect world, but in the life you're actually living. The first step is to identify which phase you're in, because the wrong action in the wrong phase causes damage. If your net worth is still building, your job is brute force with restraint. If your net worth is established, your job is patience with protection. Confusing these roles is costly. Step 1. Define a do not touch line. Set a clear boundary between capital and consumption. This doesn't mean deprivation. It means sequencing. Decide explicitly that investment capital is not lifestyle money until it produces income on its own. Not because spending is wrong, but because timing matters. If you haven't crossed that line yet, your discipline is doing future you a favor. Step 2. Automate progress. Minimize decisions. Manual decisions invite emotion. Emotion interrupts compounding. Automate contributions to retirement and investment accounts, so progress happens without negotiation. Once set, resist the urge to constantly optimize. The goal is not perfect allocation. The goal is continuity. Step 3. Simplify your investment structure. Complexity increases the chance of intervention. Choose a strategy you can explain in plain language, especially during stress. If you can't explain why you own something without checking a chart or a forecast, it doesn't belong in the foundation. This is where many people overestimate their tolerance for volatility. Step 4. Raise your savings rate before raising your lifestyle. When income increases, treat it as an opportunity to accelerate the base, not expand commitments. This step feels unfair. It's also temporary. Every dollar redirected early has an outsized impact later. Delay consumption until capital, not salary, supports it. Step 5. Prepare emotionally for boredom and doubt. This is the step nobody talks about. There will be years where nothing dramatic happens. No breakthroughs, no validation. That silence is not failure. It's the process working. If you expect excitement, you'll seek it. And excitement is expensive. Addressing the objections. What if I'm starting late? Late is a relative term. The math doesn't care about regret. Only inputs and time. Consistency still works, even on a compressed timeline. What if I fail? Failure usually comes from interruption, not inadequacy. Avoiding obvious mistakes is more important than getting everything right. What if the world changes? It always does. The strategy isn't predicting the future. It's surviving it. Charlie Munger believed that preparation beats prediction. You don't need to know what will happen. You need to avoid what will break you. Step 6. Revisit infrequently, not constantly. Set a schedule to review progress annually, not weekly. Frequent checking increases emotional reactivity. Annual reviews encourage perspective. The goal is to stay invested in the process long enough for the process to matter. Step 7. Measure progress correctly. Stop measuring success by short-term outcomes. Measure it by whether you stayed disciplined. If you saved consistently, avoided unnecessary changes, and let time pass, you're winning, even if it doesn't feel like it yet. These steps aren't flashy. They won't impress anyone, but followed patiently, they do something far more valuable. They make financial outcomes predictable. And predictability, at this stage of life, is the real luxury. Step back and look at the whole arc, not the headlines, not the market noise, not the stories that make wealth seem dramatic or chaotic. Look at the pattern. First comes effort with little visible reward. Then comes doubt. Then comes temptation to spend, to chase, to interfere. Most people never get past that stage, not because the system failed them, but because they misunderstood what the system was asking of them. The truth is uncomfortable. Wealth is not designed to encourage you early. It withholds feedback on purpose. It tests whether you can operate without applause, whether you can act rationally while progress feels slow, whether you can delay gratification without knowing exactly when it will pay off. Those who pass that test don't become rich overnight. They become unstoppable over time. What ties everything together is not money itself, but behavior under uncertainty. The foundation phase demands discipline when results are quiet. The application phase demands restraint when temptation rises. The advanced phase demands humility when success finally arrives. Each phase has a different emotional challenge, but the same underlying rule: don't interrupt what's working. This is why so many people with high incomes still feel anxious. Income solves lifestyle problems. Capital solves time problems. And time, freedom over your own time, is what people in their later years value most. Charlie Munger once summed up this entire journey with a philosophical clarity that rarely shows up in finance. The best thing a human being can do is to help another human being know more. Knowing more isn't about complexity. It's about understanding what not to do, not chasing envy, not fearing volatility, not mistaking boredom for failure. When these lessons are internalized, something subtle but powerful happens. Money stops being emotional. Decisions slow down. Confidence becomes quiet. You stop asking, "Am I winning?" and start knowing, "I'm positioned." That shift changes how you age, how you work, and how you sleep at night. Because the ultimate purpose of wealth is not consumption, it's dignity. Dignity in choice. Dignity in retirement. Dignity in saying no when it matters. The people who reach that place rarely look extraordinary from the outside, but internally, they experience something rare. A life that feels steady, because it was built deliberately. If you've stayed with me this far, you already understand something most people never will. Wealth isn't about intensity. It's about staying rational longer than everyone else. And that's not a talent. It's a habit. If this way of thinking resonates with you, consider subscribing. Not for alerts or noise, but for perspective. This channel is built for people who care less about hype and more about outcomes that actually last. In the next video, we'll go deeper into why time, not income, is the real driver of financial freedom, and how small behavioral shifts compound just like money does. Before you go, I want to ask you one thoughtful question, not for the algorithm, for clarity. Where are you right now in the journey? Are you still in the brute force phase, building the base quietly? Or have you reached the patience phase, where the hardest job is simply not getting in your own way? Comment brute force or patience below, not to compare, just to reflect. Charlie Munger believed the most powerful advantage in life was learning how the world really works, and then acting accordingly, even when it's uncomfortable. The math will outlive all of us. The discipline you choose today decides whether it works for you or against you. Thanks for spending this time with me.